All right, sorry for the delay. It is 10:03, 3 minutes late. This is Sam Jones. Thanks for joining this morning or this afternoon if you're calling in from the East Coast. This is our Solution Series webcast. We're trying to do these every 6 to 8 weeks that are sort of topically driven. And the topic today is the real cost of investing. I sort of came up with this concept out of frustration, really just in reading financial magazines, in which I saw ads constantly placed talking about the cost of investing and sort of bidding for your business by saying, well, we're the cheapest provider of this or that. And I found myself scowling and saying, gosh, I can't believe that they're putting this out there. They really don't have any concept of what the real costs of investing are, or what an investor faces in relation to costs. So I thought I would put this together and really just map out what do we look at in terms of costs. It's not just the cost of a security, and I think that's one of the main points. Just in terms of a quick agenda, I want to look at those actual costs, the inherent costs of different securities. I want to compare the different costs of asset management styles. This might be managed accounts for someone. And then I want to look at the flaws specifically behind this pitch of low-cost investing. And that has everything to do with those three items there, the performance behavior gap, the cost in time. Time is money, time is a cost in recovering from losses, and then also opportunity cost of money that's not invested. These, to me, are much bigger costs that people don't really pay attention to. I'll try to boil all that down to sort of a best bang for your buck, meaning from a holistic cost standpoint, what do I think is the best approach? And then I'll whip through some common questions and answers. If you do have questions as we go along and you want to type them into the chat room, everybody is muted at the moment. Questions as they come up, go ahead and type them in the chat room and I'll try to answer them as we go. Should take about 15 minutes all in. So here's the pitch that we see, and you'll see these types of ads from iShares and Vanguard, BlackRock, etc. And this is what they tell you. They say, if you put your money with iShares, we will help you keep more of what you earn. And I laugh at that because there's so many assumptions in that very simple sentence. The assumption is primarily that all you have to do is put your money into one thing and it will earn money and it will always go up. Well, what a comic thing to, after an entire secular bear market where people lost their shirts, lost 45 to 50% twice in a 10-year period, and made virtually nothing from the year 2000, as if that was just an assumption. So again, here's my deep eyebrow scowl at this type of marketing because it's just simply deceptive. So let's pick that apart anyway. I mean, let's play the game and let's look at cost. And I do acknowledge that index funds and ETFs are absolutely the cheapest, and we use them as much as we can. So let's look at the comparison of actual costs. On the left-hand column, we have types of cost. The next column over, we have managed mutual funds. Next column is indexed mutual funds or exchange-traded funds. And then on the right-hand column, we have stocks. So you can follow that through. Expense ratios internal to actively managed long-only mutual funds tend to be between 1.3 and 1.5% annually. Pretty high number. Index mutual funds and ETFs, the average is now 0.2, so 0.2%. Very cheap, a whole lot less than 1.3. And that's really where that marketing bonanza comes from. Stocks have no internal costs. Redemption fees, you're going to start to see managed mutual funds look very ugly. Managed mutual funds carry 1 to 2% redemption fees. I was shocked in looking at the Fidelity Funds network, of which there are 17,000 some odd mutual funds. 63% of those funds have either redemption fees or sales charges on them. It's just shocking how many funds have gone that direction. Again, these are actively managed funds. There are no redemption fees on index mutual funds or ETFs, and of course not on stocks. sometimes there are now custodial redemption fees. So the custodians would be like Schwab or TD Ameritrade or Fidelity. They are now imposing their own redemption fees, which to me is just a revenue grab, but they can be as high as 0.5% or a dollar cap, sometimes around $100 if you sell a fund, a mutual fund, within a certain time period. Index funds, ETFs, and stocks, none of that junk. Transaction fees, actively managed mutual funds, many of them, almost half have $25 transaction fees now. Indexes, ETFs, and stocks, almost all are down to about $7.95 each direction. So for a buy or a sell, it's $7.95. Sales charges, same thing, just oppressive revenue grab from these managed mutual funds. They could be as high as 4% or 5% sales charges. No sales charges on index funds, ETFs, or stocks. Finally, tax distributions. Many actively managed mutual funds internally are distributing their non-benefit gains to shareholders annually. These have no value to you as a shareholder. They're just offloading their tax liability to you. It is different, quite different, than a dividend or any form of interest that you might receive from a stock or a bond. So you're going to see here, obviously we want to live in the right two columns there. We want to only look at index mutual funds, ETFs, or stocks. And in our shop, we are very rarely using managed mutual funds anymore. We really exited that pool of securities, I'm going to say 4 to 5 years ago, with only a few exceptions. So really that's a cost comparison. Again, shifting gears here, looking at a different type of cost, we're really looking at managed account costs now. These are the costs that you would pay someone like us to manage your accounts. Management fee, FAB on top, is features, advantages, and benefits. We have a do-it-yourself investor in the right hand in the next column. Fee-only passive allocations. These are sort of the guys that are putting your money into a variety of index funds, stocks, maybe some bonds, maybe some commodities, and then that money sits and it doesn't do much. And the market can go up and the market can go down, and you're going to own the same stuff up or down. Risk managers tend to be a little more active. This is really our world, fee only, where we are taking steps to be in the right, taking steps to have assets in the leading securities, avoiding risk areas, and even cutting market exposure if we need to. So there's definitely more activity there in general. Commission-based brokerage, this is your classic sort of Merrill Lynch brokerage model where you have a broker who's still somehow miraculously charging commissions and getting away with it. And then also collecting trails. Trails are fees paid by mutual funds to this same broker. So if we walk down the left-hand side, you can see there's management fees and all those other types of costs. Management fees for passive accounts, 0.6 to 1.5. You can read that stuff. Risk managers are charging between 1 and 2.5%. That seems to be the most common range. It's a pretty big range. And then brokerages, you know, again, they're paying commission, sometimes 4 and 5% on each purchase. Unbelievable. Transaction costs for the do-it-yourselfer, unknown really. Depends on how active that do-it-yourself investor is. If they trade a lot, transaction costs can be up there. Passive managers, fee-only passive guys, they're barely trading, if at all. So their range of costs are between 0 and 0.1. Risk managers, I used our own data here on transaction costs across all of our strategies. Our most expensive strategy against an average account size is seeing about 0.25% per year in transaction costs. That's the most expensive, and it drops down to 0.08 for a lot of our strategies. So we're still not trading a lot. There's plenty of things we can trade without a lot of transaction costs. Again, commission-based brokerage, just offensive. Commissions, trails, way too expensive. In terms of time, again, I look at time as a cost. Do-it-yourselfers, you should be spending a lot of time. If you're not, you're probably not really managing your money. Obviously, if you're paying someone else, you're going to have 0 time involved. whether that's fee only or commission based. Owning what's good for you, I threw this in as sort of a cost in a way. It's something to look at because I think there's some real differentiators here. We all want to own what's good for us, including the do-it-yourself investor. The fee-only guy, or in either realm, passive or active, is always trying to own the right thing for you. But in reality, there isn't a lot that you can do in terms of stepping away from that. As a commission-based broker, again, they would have to say, like, who cares whether or not you're really owning the right thing? They get a commission and they're on their way. Who carries the risk? I think you carry the risk as a do-it-yourself investor or a fee-only passive person or a fee-only risk manager. You are carrying the risk as a passive asset allocator. When you're hiring a risk manager, that risk manager is carrying the risk for you or effectively being accountable for that risk. In a commission-based model, I think you're carrying the risk again. So those are sort of your cost comparisons. I want to pick on that pitch of low cost and look at some of the flaws on that. One of the primary flaws in the cost argument of just low cost is that it ignores a massive behavior gap. And we know historically that investors tend to buy high and sell low. And I've circled those places where you can see the fund flows in, circled on the top, and the fund flows out at bottom. It's pretty massive. It looks like fund flows are in right now. You can see on the right-hand side of that chart, obviously, and that would correspond with the market. As a result, we've seen this before from this Dalbar study, that investors really pay a cost of bad performance based on their own performance behavior gaps. So the market has produced about 8.2% on average for the last 20 years in the S&P. Bonds have produced 6%, and yet the average equity investor has only made 4%, and the average bond investor has only made 0.9%. So again, we're really talking about a real cost of bad behavior here, regardless of what you own. So the entire pitch that says just own something that's cheap and you'll earn money or keep more of what you earn is just entirely flawed. The second flaw is really about the cost of lost capital in terms of recovery time. And we know that if you lose a certain amount of money, in this case, let's say 15%, you have to make more than 15% to get even or to come back. If we even assume a fictitious 7% rate of return year over year with 2% inflation, it still takes 7 years to recover from a 15% loss, even at that rate. There's a cool calculator that does this, that you can actually measure how long it takes you to recover. Obviously, the bigger the loss, the longer the recovery time. So the 25% loss takes a 33% gain to come back. There's a 7%, that same return on investment. The recovery time expands out to 10 years. If we lost 45%, which again happened twice in the last 10 years, it takes an 82% gain to come back in 16 years of time. So again, forget about the cost of the underlying securities, this pitch, and look at the cost of time of how long it takes you just to recover from a loss. I guess I can't help but think that people are generally looking the wrong way. Speaking of the funny picture of this group of people standing in a boat looking the wrong way as this giant whale is breaching behind them. But there's a real opportunity cost of not really paying attention to your whole portfolio. That includes cash. There's $11 trillion of cash sitting in checking, savings, and money markets accounts, earning zero interest. The stock market's up over 200% now since March of 2009. So again, if you have a tiny piece of your portfolio invested and all you're doing is paying attention to the underlying costs of your securities while you have a big pile of cash doing nothing, I would say you're not really paying attention to the total cost, opportunity cost in this stance of your portfolio. So those are sort of three primary flaws I have with this low-cost investing argument. I think people should pay a lot more attention to these three elements: managing your market risk, looking at your whole portfolio, how much cash you have on the sidelines, and looking at recovery lost time as a real cost. So best bang for your buck, if I factor all that in, looking at cost of securities, lost capital, recovery time, behavior gap, cost of time in managing your own accounts, responsibility of risk, and what's really good for you, who should you hire to manage your wealth, who cares about you. I think really that fee-only risk manager using low-cost stocks, ETFs, and index mutual funds is really your best bang. That, of course, is our business model. That's who we do, and it sounds self-serving, but I just wouldn't manage money another way. I don't believe in my heart that that there is a better way, that the holistic cost approach would dictate any other solution. I think that's your best bang for your buck, and that's, again, what we do on purpose. That's where we feel like we should operate. So just obvious Q&A. What about tax costs of trading? They're really too variable. People have all different tax structures, but certainly there are plenty of trading strategies now that can actually increase your tax efficiency through tax loss harvesting. We can avoid mutual fund distributions. With that said, retirement accounts are absolutely still the most appropriate. There are a whole new breed of these, what they're calling robo-advisors or robot advisors. Wealthfront and Betterment are probably the two biggest. I do think that this is basically an online algorithm that runs a passive asset allocation model for you. You don't have to hire some guy to do that. The costs on these things are minimal for management. $30, $50, $100 a year. I mean, very, very cheap. Institutional Investor just ran an article called Robo-Advisor Model Remains Unproven, wondering whether these guys can even remain solvent with that type of cost structure or fee structure. But I do think at this point they're collecting billions of dollars. I do think it's going to cut into that passive asset allocation manager's business. We're not in that business. I'm not concerned about it because people pay us to manage risk. These models don't manage risk. They buy things for you based on some algorithm on your age and your hair color and your whatever. And you're supposed to sit with that for 10, 15 years and hope it works out. Maybe that's great. Maybe it's not. I'm not really willing to gamble with my net worth like that. And I don't think people with real money are either. So far, that type of thing has attracted a younger, much less affluent investor. Average account sizes are $3,000. Anyway, it is a new thing, and it probably will gobble up some market share. What about the cost of underperformance among risk managers? This is always something we have to address. If we are mitigating market risk, stepping out of the market, cutting exposure even as the market's going up on purpose, inherently we're going to underperform on the way up, as we do always. But that gap in underperformance is almost always, and so far in the last 15 years this has been the case, the gap is closed during the course of the next bear market. So when stocks turn down, then we outperform and the gap is closed to our advantage. I guess I find it remarkable that we pay insurance for everything. We pay insurance for our phones. We pay insurance to warrant against even a minor risk in our lives. And yet many people are not willing to sort of pay insurance, if you will, or pay a premium for control of their net worth, their entire net worth. It's just incongruous to me that people don't behave, they don't look at things in terms of the real risk of life. I mean, who cares if I drop my phone, but what if my entire portfolio loses 45%? Nobody seems to be willing to risk it or to pay any sort of premium. So I look at underperformance as a bit of a risk premium, as an insurance premium. But it certainly leads to a tolerable investing experience. So that's sort of it on cost. I guess I just wanted to bring that to everyone's attention based on our research. That's kind of the way it lays out for me, or the way we think about it. Happy to take any questions if anybody has them. And we can just go from there. If you do have a question, you can put it right on the chat box down in the left-hand corner. If you don't have any questions, we can just wrap it up. All right. Well, you guys are easy today. We will post this online so you can check it out. And thank you very much for attending, and we will talk to you soon. Bye-bye.